Welcome to macroeconomics class. This is the 6th module, and we'll be talking about money and banking. And for this module, we'll look into the relationship between the two concepts, and this is crucial for understanding macroeconomics behavior and monetary policy. Now, when we talk about money, what is money? Money is the fundamental medium for economic transaction, evolving from barter to digital form, and it serves 4 key functions that enhances economic efficiency and scalability. And the first is it's being a medium of exchange, and this is widely accepted for goods and services, eliminating the need for direct barter. Also, it functions as a unit of account. That is, it provides a standard measure of value for pricing and comparing items. Also, its function as store of value. That is, money retains value over time, supporting savings and investments dependent on pricing scalability. And the last is the standard of deferred payment. So it's being used to settle funds, future debts, enabling credit transactions and long-term financial planning. What are the types of money that we have? When we talk about the types of money, it's kind of look into how money evolves, also how the use of money evolve. But we'll be looking in a place of the types of money. And when we talk about types of money, we look at it as that which transformed from item with intrinsic value such as gold and silver onto the abstract digital form that we are seeing now, and reflecting changing economic need and technological advancements. And the first type is the commodity money, and this is used, it is the use of items with intrinsic value as money, and it is stable but impractical for growing economics due to weight and limited supply. Another is the bank money, which is the deposit money, and these are deposits in commercial banks used in via checks, debit cards, and online banking, and it is created through bank loan, significantly impacting money supply. Another is the fiat money, and this is a money with no intrinsic value, and it derives value from government authorities and public trusts, such as the US dollar, and regulated by the central bank. Another is the electronic or digital money, and this is purely in digital format, such as the mobile wallets, the online bankings, which offers speed and conveniency, enabling remote and instant transactions to be performed without having to go to the bank. And another is the cryptocurrencies, and it is a decentralized digital currency, such as Bitcoin, using cryptography, and it operates on blockchain not issued by central authorities with volatile nature. And we have a concept in money, which is the money supply. And when we talk about money supply, it is the total stock of money in an economy categorized by liquidity, and it's influenced by central bank policies, commercial banks, public behaviors, and reserve ratios. And as such, the central bank and economics typically classify money supply into various components, and these are, the first is the M1, and this includes the most liquid form such as physical currency, demand deposits, and other on-demand deposits. The M2 is the second classification, which talks about a broadened M1 plus less liquid forms such as saving accounts, small time deposits, non-institutional money market fund. And the next is the M3, and this includes M2 plus large time deposits, institutional money market fund, and other large liquid assets. And the last is the I powered money, and this is currency in circulation and commercial bank reserve with the central bank, and it is the monetary base for credit creation. In money supply, we have money multiplier. And when we talk about money multiplier, it is how an initial change in the money base can lead to a proportional change in the money supply, driven by fractional reserve banking. And you can see the formula. So, for example, if the reserve ratio is 10%, which is 0.1, the multiplier will be 1 divided by 0.1, which is 10. And that means that if there is, if 1 trillion naira was injected in the as base money, it could result into 10 trillion in total money supply through lending and redepositing. As per money demand, when we talk about money demand, it is the amount of money, monetary assets, household, firm, and government wish to hold. And in talking about holding of money, there are three motives through which we hold money. And these are the transactionary motive, the precautionary motive, and the speculative motive. The transactionary motive is holding money for daily purchase of routine expenditure, and it's positively correlated with income and economic activity. The precautionary motive, on the other hand, is the household money, as it is holding money as a safeguard against unexpected events or emergencies, and it depends on economic uncertainties. And the speculative motive is holding money based on expectation of future interest rates and bond prices, and inversely related to prevailing interest rates. We have the commercial bank and the central bank, as we've been talking about, as we as two major things we need to look into. And for commercial and central banks, they are distinct yet complementary, and each serving a vital role in the financial system. As per the objective, the commercial bank provide a is there for profit maximization through financial services, and the objective of central bank is to ensure that monetary stability and macroeconomics management. As per the service they perform to the public, central bank accept deposits, offer loans, and commercial services, while the central bank does not deal with the public directly. They work with the other tiers of bank, the central bank, commercial bank. And then as per the currency issuance, commercial bank is not authorized to issue currency, while the central bank has the sole authority to issue legal tender. As per credit creation, commercial bank is actively creates credits by issuing loan, while central bank regulates credit in the system. As per relationship with government, the commercial bank serves government as a banker and debt manager indirectly, while the central bank is a direct banker and advisor to the government. And as per the regulatory role, the commercial bank is subject to regulation, while the central bank regulates and supervises the commercial bank. And as per the lender of the last resort, the commercial bank cannot perform this function, while the central bank acts as lender of last resort for financial institution, including the commercial bank. We talked about credit creation and when we are trying to distinguish between commercial bank and central bank. Now, what does this mean? Commercial bank generates money by accepting deposits and extending loan through the fractional reserve banking system and significantly impacting economic activity. So, for instance, let's assume a customer deposits 100,000 naira in bank A, and the required reserve ratio is 10%. So the following steps are to be taken. The first is bank A keeps the 10,000 naira, which is 10% reserve, and lends out 90,000 naira. And the second is the 90,000 loan is spent and deposited into Bank B. While it's deposited into Bank B, the third is Bank B keeps 10% of hits, which is the 10% of the 9,000 naira, and I mean 90,000 naira, which is 9,000 naira, and lends out the 81,000 naira remaining. And when the 81,000 is deposited into Bank C, which keeps 88,100, which is the 10% of it, and lends out 72,900. And this is how the process actually is in creating credit. And this process is limited by cash reserve ratio, loan demand, monetary policy leakage, and regulatory measures. In conclusion, money and banking are the backbone of modern economies, facilitating transactions, enabling savings, and driving growth. So money functions as medium of exchange, unit of account, store of value, standard of deferred payments, and are crucial for economic efficiency. And money supply is influenced by central bank policies and commercial bank credit creation, determining liquidity and inflation. Also, demand for money depends on interest rates, the income, the inflation expectation, shaping monetary equilibrium. And commercial bank amplifies economic activities through fractional services. And lastly, central bank regulates money supply, stabilizes price, and ensure financial stability. Thank you.